India's steel and mining industry is evolving faster than ever. But real progress happens when ideas, technology, and leadership come together. With 10+ years of experience, Metalogic has been connecting the steel ecosystem through impactful industry platforms across Pan-India. We bring together CXOs, plant heads, innovators, and decision-makers shaping the future of steel and mining. Focused events for the steel and mining sector. Tailored, customized events designed for your business goals. Research-driven forums delivering real industry insights. Powerful product and company launches that capture attention. Because we don't just host events, we create industry brands. From brainstorming sessions to live demonstrations, we create spaces where innovation comes alive, and exhibitions that showcase the technologies shaping tomorrow. Metalogic events, connecting ideas, industry, and innovation. Join us to shape the future of steel and mining.
Non-stop. Non-stop.
India's steel and mining industry is evolving faster than ever. But real progress happens when ideas, technology, and leadership come together. With 10+ years of experience, Metalogic has been connecting the steel ecosystem through impactful industry platforms across Pan-India. We bring together CXOs, plant heads, innovators, and decision-makers shaping the future of steel and mining. Focused events for the steel and mining sector. Tailored, customized events designed for your business goals. Research-driven forums delivering real industry insights. Powerful product and company launches that capture attention. Because we don't just host events, we create industry brands. From brainstorming sessions to live demonstrations, we create spaces where innovation comes alive, and exhibitions that showcase the technologies shaping tomorrow. Metalogic events, connecting ideas, industry, and innovation. Join us to shape the future of steel and mining.
Good afternoon, everyone, and a very warm welcome to all our speakers and participants joining us today. On behalf of Metalogic Projects Management Services, I warmly welcome you all to yet another insightful session. It gives me a great pleasure to host this webinar number 61 in our ongoing knowledge series, where we continue to bring together industry leaders, experts to decode the most critical developments shaping global commodity and trade. For those joining us for the first time, for them, I want to bring a little introduction of Metalogic. Metalogic is a research-driven platform focused on the steel and raw material ecosystem. Over the last decade, we have gone beyond traditional conferences to build a space for thought leadership, market intelligence, and meaningful industry dialogues. And today's discussion is exactly in that spirit. A little housekeeping note, this session is being streamed live on our YouTube channel. So just in case you're facing any difficulty, you can visit to youtube.com/Metalogic PMS. So all of you, our online viewers, welcome, and we look forward to your participation through comments and questions. Now, coming to the program theme today, global shipping disruption, rising freight, insurance cost, and impact on steel and energy trade comes at the right time when geopolitical tensions and uncertainty are significantly reshaping global supply chains. We are witnessing rising freight rates, unprecedented insurance premium, rerouting of vessels, and increasing operational complexities across key trade routes, particularly around critical regions like Strait of Hormuz. At the same time, the dry bulk segment, which forms the backbone of global trade in iron ore, coal, fertilizers, and other essential commodities, is experiencing its own set of challenges. From shifting demand patterns and evolving trade flows to the impact of bunker cost and freight volatility, the dynamics of dry bulk shipping are becoming increasingly complex. These disruptions are not just limiting to shipping, they are cascading into steel, energy, and bulk commodity markets. From changing sources, strategies, and cost pressure on industries to the potential impact on fuel prices, the ripple effect are far reaching. The situation is also raising important questions around risk management, trade sustainability, and the future structure of global logistics. Today, we are joined by our esteemed panel of experts who bring deep on ground experience and analytical insights into these developments. I am confident that this discussion will help us to cut through the noise and truly understand what lies ahead for the industry. This discussion also comes at a very relevant time as Metalogic is preparing to host two international conferences. One is International Iron Ore Conference on 19th of May in Goa, and also we have a Steel Technology Festival on 26th May in Delhi, which will bring together global Indian leaders and the mining steel industry to discuss production outlook, trade flows, logistics, and future of iron ore markets. So, there are several questions like, so we are looking at a logistic crisis turning into trade crisis. Is this disruption cyclical or are we rewriting global shipping economics? Are we underestimating the record second order impact on steel and infrastructure demand? Today we have with us Captain Amit Kumar, General Manager Chartering, Bainbridge Navigation Private Limited. We have Captain Vijay Hadkar, Head STS Operation, Ship to Ship Private Limited. And we have Rahul Sharan, Deputy Director, Bulk Research Dury Shipping Consultants Limited. And I'm your moderator. So we are hearing the unprecedented disruption across the Persian Gulf and Strait of Hormuz, from rising the freight and extreme insurance premium. From your perspective, how severe is this situation compared to the past crisis? I want to bring this question to Captain Amit Kumar Anawat, General Manager, Chartering Bainbridge Navigation Private Limited. So, Captain Amit, I request you to please unmute your mic.
Thank you. Thank you, Monica ji. First of all, I would like to thank Metalogic for giving me the opportunity to join the online webinar and put my points across. Thank you. Thank you, Monica. Thank you, Metalogic. Regarding the question of the closure of Strait of Hormuz and the increasing of freight rates. Yes, unfortunately, ma'am, first of all, if we see the freight market, it was very competitive since the Mr. Donald Trump has won the elections of the US presidency. So the market was disrupted from the last, I would say, 1.5 years. Sometimes due to tariff, sometimes he said that the vessels coming from China will not be allowed to the US. So there was a logistics disruption. And now here it comes, the closure of Strait of Hormuz. If we start on a basic way, generally before this closure of Strait of Hormuz, I would say before the start of the war, on a specific basis, the iron ore shipment, I would take an example from East Coast India to China. Generally, on a Supramax basis, a load of 55,000 to 60,000 metric tons. The freight was $11, depending upon the vessel, like 11 or 11 and a half, you can say. And this is, I'm talking about 1 month before. Now, then this Iran and US-Israel war happened. The Iran retaliated and the Strait of Hormuz is closed. So there is a sudden spike in the bunkers. Now, if you see the exposure of the bunkers before the war, on a vessel carrying an iron ore, it was like 40% is the higher. Higher, I mean, is like the payment given to the owners per day basis. So the whole business, 40% stake is the higher, and the 40% stake is the bunkers, the price of the bunkers for the voyage. That comes to 80%, and 20% is miscellaneous like port charges, insurance, and different additional expenses we have. After the war, the bunker component rose to 60%. And the higher component went down to 30% because, again, the owners were pressurized to lower their hire rate so that the trader or the miner can sell the iron ore to China, or the receiver. There is a certain economics on the, like, miner cannot go down below certain value. Like if he is mining an iron ore of $100 per ton, he cannot sell it $90 per ton because the margins will be squeezed. Now, due to the sudden, or the buyer, let's say buyer, the steel mills, like if they are buying an iron ore to prepare the steel and to export it, that certain level of they cannot purchase more than that, because again, then there will be a negative margins on the mills. So to compensate that, a bit of the hire of the owners were reduced, and the bunker cost has gone up. Now the freight gone up around 15 to $15.5. It was earlier $11 and now it is $15, only due to the bunkers, which is a cost of $4 per ton. That means 50,000 into 4 is 200K.
So, Captain
USD.
Amit, we will come on to the freight levels in my next question. I want to understand from Captain Amit, how severe is this situation for the shipping industry? Captain Vijay.
Okay.
Sorry, Captain Vijay.
Captain
I
Vijay
want
or
to take
myself?
this similar question to Captain Vijay after that, Rahul. Yeah. Please unmute Captain Vijay.
First of all, I would like to thank everyone for inviting me. It's quite a pleasure. Coming back to your question, Monica, if you see the world economy, it basically revolves around the oil. How the oil inflow in the whole world controls each and every trade, including the iron ore, including people's buying capacity, including economy of the world, countries. So after talking to various stakeholders, I realized this war will have a major impact. In fact, because India is a big country, we have a lot of storage. We are still good with oil. Because we have an agency house which handles around 500 ships in a month also. So volume has reduced drastically. Crude oil now, which was coming from the Gulf, it is coming from Russia. Most of the books are filled up with the Russian crude now. And to process that Russian crude, again, the refinery is not very well equipped. So the product which comes out of the refinery is also changed. The figures have been changed. We have Naira, we have Reliance, we have IOC, BPCL, HPCL, who has refinery here and who are the major producer of the oil. So we are still better than other neighboring countries. As far as freight is concerned, the ships are not ready to go to Gulf of Hormuz. It's as simple as that. They are just scared because once it is any say bomb or anything which hit the ship, definitely it will destroy, and that insurance is not ready to pay any extra this thing. So we have a tough time because freight has increased a lot. Like I remember Nanda Devi, which it came to Mundra. We have done the ship to ship operation, and then she proceeded to again the Strait of Hormuz because India's relationship with the Iran. So there is an additional cost involved in case this war continues, and I feel it is a grave. We have to have some immediate measures to control it. Otherwise, the economy will start collapsing. So that is my take on this.
Thank
So
you,
yeah,
Captain Vijay. Yeah,
thank
Rahul,
you.
if you could also bring a perspective, how severe is this situation?
Okay, thanks, Monica. So there are two things. One is how different is this from the previous, disruptions to shipping, as you asked earlier. The first part is that this time, what has happened that disruptions, for example, what we saw in the Red Sea crisis, the ships were taking a longer route. So in that sense, the voyage distance increased, but disruption to shipping per se was not that severe. This time, the cargo is not moving at all. Secondly, we are talking about Strait of Hormuz closure. We never thought that it would happen one day, and we are seeing that almost 20% of global crude is supplied from that region, and that is almost stuck up completely, except for some pipelines. So we are seeing this never happened. So in earlier occasions, what happened that the cargo were moving, but with a larger sea distance, but this time it is almost stuck up completely. So this is, of course, very, very severe situation that we are seeing.
So, coming back to Captain Amit, so you were talking about the freight rates, which has gone up to $15 from East Coast India to China. Is this a temporary spike or the beginning of a structural shift in shipping cost? Captain Amit.
Yes. Yeah. Thanks, man. I got the question. It's a temporary or it's a change of the.
Yes,
Ma'am,
structural shift
personal,
or
I
hmm.
personally I feel, ma'am, it's a short-term spike because I don't think so that it will stay forever. Once the Strait of Hormuz is open, things will normalize. Yeah, but it would take time. I would say, like, if it is open today, then I think it will take around 3 to 4 months to get normalized. So I think it's a short-term spike, but may partly stay if disruption continues. So if it will partly stay because right now, today I was reading one article like 1,500 vessels are inside the Persian Gulf. They are stuck. They are not moving. They are anchored. They are at berth, or they are at drifting, and 200 of them are AIS off, automatic identification system. There is one instrument which tracks from the satellite the position of the vessel. They had switched off. So 1,500 vessels are stuck.
1,500, you're saying
So it is
1,500 vessels are stuck.
yes, and these are like various vessels, like some are bulk carriers, some are chemical tankers, some are LPG carriers. And our region, the region, the like Indian Ocean and the Pacific region is most disturbed, I say, because of due to the Strait of Hormuz. Because if you see, the major oil is like Russia has oil, US has oil, Libya has oil, and after that we have this Persian Gulf area. So all the Europe gets from the US or from the Libya, from the Mediterranean. But this our part, like near to Singapore, Southeast Asian countries like China, Vietnam, Philippines, India, basically. So we get oil from majority of the oil comes from the Persian Gulf. And in fact, gas, our LPG gas is like the industrial and household gas which we use is 80% from the
Okay. So
in our area it is very much disturbed.
Rahul, when we are talking about the freight levels and costing, I want to ask you, with rising bunker cost and fuel supply disruption, how significantly is this impacting freight rates and vessel deployment strategies? And also, are we entering a phase where bunker volatility is driving freight more than demand? Rahul.
Yes, thank you. I will also, break it down to what Captain Amit was saying. He mentioned that the recent spike in freight rates, they are mostly due to bunkers. I completely agree with that. So, the fundamentals are still there. So when we talk about, so there are different scenarios basically. We will talk about the dry bulk ships at the initially. So when we talk about dry bulk ships, the fundamentals of demand and supply are intact. The Middle East crisis does not have a major impact on the global demand because the global demand is still majorly driven by China and other Asian economies. So we do not see any major disruptions from the demand side. Similarly, from the supply side, there are more than 14,000 dry bulk ships, 14,600 or 700, approximately those numbers. And roughly around 200 of those dry bulk ships are still trapped inside the Persian Gulf or Arabian Gulf. Again, I will give some numbers. So there are 14 LNG ships are still inside. 16 VLGCs are inside. When we talk about the tankers, as of today, there are 80 crude tankers, 87 product tankers. They are inside. So these are the exact numbers that we talk as today. So they are still there. But when you talk about the global perspective, 200 dry bulk ships vis-a-vis 14,000, more than 14,000 ships. So the supply side is hardly affected. Even in terms of the gas carriers or LNG carriers, roughly around 2 to 3% of the global fleet is inside that Gulf. Other than that, rest of them are still sailing. So supply demand fundamentals are intact. So no major difference. The difference has been the bunker prices. I will take a benchmark route C3, which is Brazil, China. So just before the crisis, it was around 24.5 or $25 per ton. And just after the crisis, say, or a day before yesterday, it was almost 30. This increase, $5 per ton increase, was only because of the bunkers. The bunker prices, Singapore bunker VLSFO, which was trading around $460, $450 per ton before this happened, this went up to more than $1,000 per ton, $1,100 per ton. After Mr. Trump's some assurance that he's trying to settle it down, it has further come down to below 900 now, but still it is more than double that we saw before the crisis. So this is actually adjustment. And I agree with what Captain Amit was saying, that the component, the bunker component of the total freight cost has actually gone up. In the longer distance, he was mentioning about India and China. In shorter distance, the role of is lesser compared to the larger distance, because when you talk about Brazil, China, the role of bunker becomes severe. So in that context, it was roughly around 50%. The total freight cost, the bunker share was almost 50%. That has gone up to 80%, rather more than 80%. So that kind of,
you're talking about the cost component of a commodity where the bunker rate itself is having a share of 80%.
Yeah, the cost component of the freight cost. So 1 ton of iron ore, shipping 1 ton of iron ore from Brazil to China, it used to cost $25 per ton. That has gone up to $30 per ton. And within that, those $30 per ton, if you break down the component of what factors, what are the cost components, the factor of bunker was 50%. It used to be roughly around 50% in normal shipping scenarios. This has gone up to more than 80% on longer routes. On shorter routes, that has gone up to beyond 60%.
Yeah, correct, Rahulji. Yes.
That is quite critical. Coming to you, Captain Vijay, I want to ask you, are small traders being squeezed out due to high freight, insurance and uncertainty? What is the impact on small traders here?
Small traders definitely had a big impact, because if you see we are talking about Indian trade, the chemical for that matter, methanol comes from the Saudi and all these small places. That has stopped completely now because Strait of Hormuz is closed. Then we were taking the Iranian cargo also. It's not that we were not taking the Iranian cargo. That has stopped now. So I think it is early stage to comment on anything right now. We have to watch the impact on the traders, because right now there is a lot of uncertainty on the Strait of Hormuz, whether it will open or it will not open. And whatever the raw material we have, we are utilizing now, and probably another 10-15 days time, if the war continues, we'll start suffering, and we'll start suffering in a big way. What I understood after talking in the market. So small traders, government needs to come up with some kind of policies, because in a larger perspective, there are a lot of impact. But right now, what impact? Nobody is going to reveal, because there are competitors, there are other factors. Of course, it will take some time. But yes, I believe it will have a major impact looking at the scenario, because the raw material, if it is not there, your production stops, your export stops, your car buying capacity reduces for the people. You don't buy the cars, you don't do the trading, and definitely it will have a impact in the long term. I feel it is too early, Monica, to comment on anything, because right now whatever they have bombarded and whatever it is spoiled, nobody is going to reveal that. So once that is been revealed, we'll come to know the exact scenario, and in fact the fuel oil prices also. So it will have a major impact, what I can see, because one of my friend works with the bunker barge in Fujairah, and he's saying every day there are some rockets are going on top of his head and then hitting some targets. So yes, what target they are hitting, it's still a question mark. No country has revealed that. But yes, if there is a major disruption, we'll have an impact, definitely. Thank you.
So there's a small clip which we want to share with our viewers to show ship-to-ship operations, and then I'll take up questions from Dr. Captain Vijay. I hope the screen is visible to you all. Yeah. So, Captain Vijay, because you're heading STS operations, which is ship to ship, we are hearing that ship to ship operations are increasing due to mid-sea cargo transfers. How significant is this shift operationally?
Definitely it adds cost to the charters. So it's not a very healthy option looking at it, looking at the economic perspective. I feel, but with the war, it gives additional support to the traders. Like if you take Nanda Devi is SCI ships. She can pass the Strait of Hormuz with the Iran support. But other time chartered vessel of IOC, BPCL, HPCL, they have refused to cross Strait of Hormuz. So what they are doing is they are bringing the Nanda Devi fully loaded. They are doing the ship-to-ship operation. They are transferring cargo from one ship to another, and then with the empty Nanda Devi going back to Strait of Hormuz with the Indian government backing, and then again loading back. So that kind of support we are providing. In that way, yes, cost will increase, because each operation will cost you with the port cost and all $200,000 or something. Other than that, of course, it is the best way that whichever ship is not ready to go to Strait of Hormuz, and whichever ship is with a higher freight, they are ready to move. This is the best way to transfer the cargo from one ship to another. We generally carry out say 3-4 operations in a month, but now we have increased up to 12 to 15 operations in a month. In fact, Saudi Aramco, just to brief you, Saudi Aramco approached us and they wanted to bring their VLCC loading in a Red Sea, come to Vadinar, do the ship-to-ship operation, and the Far East VLCC will take that cargo to the Far East, like Japan and China and all these places. So they are working on that perspective also. So war has created those kind of situation which was nearly impossible to think of before. And Wardin are being strategically, it's very safe place as far as war is concerned, because Iran is not going to bombard all these places in the Gulf of Qadr. So yes, it has changed some kind of thinking about the world, how the cargo movements are going to be there in the future, and they are also looking for the options in case this breaks out. But now I am seeing one STS is happening with 100,000 jet oil being transferred to another ship. So these are the operations will be frequent in the future if war continues.
Okay. And audience, coming to your favorite part, we are going to launch some poll in front of you. So these questions are visible to our audience. They can see over the screen. We have simple questions. You just need to answer in whether you agree or you disagree. So the question number one, which we want to ask from our audience is, freight rate today are being driven more by disruption and cost than by actual cargo demand. Do you agree or disagree? Our next question is, global dry bulk trade is still heavily dependent on China, and that remains the biggest risk. Do you agree or you disagree? Our question number three for you, audience, is, India is set to become a major driver of global dry bulk demand in the coming years. Do you agree or disagree? The question number four is for India. Diversifying import sources is now more important than optimizing for the lowest cost. Do you agree or disagree? The question number five for you is, maintaining higher inventory or strategic reserves is becoming essential for import dependent sectors in India. Do you agree or disagree? Question number six in front of you. Strong supplier partnership and long-term relationships will matter more than price negotiations going forward. Do you agree or disagree? And the last question in front of your screen is, procurement teams in India are still underprepared to manage risk like freight volatility, currency, and geopolitical. Do you agree or disagree? So while our audience is answering the poll question, this is their favorite part. I want to come back to Captain Amit. Captain Amit, I want to understand from you, with a large number of vessels reportedly stuck or rerouted, how tight is vessel availability currently, especially in the Supramax or Panamax segment, if you could tell us?
Ma'am, the vessel availability, straight in the sense, I would say that is not much. Means that is not affecting the trade. Because as Mr. Rahul said, that there are only 200 bulk carriers stuck in the PG. But the problem we are facing is the vessel availability on the nearby area, or the area which, like, generally we do a lot of cargoes of limestone from PG to West Coast, which is used for JSW steel. And in this, we use Panamaxes and Supramaxes. So now, for getting the limestone from Mina Sakar, UAE to the Mumbai, we used to pick vessels nearby, like West Coast of India, Mumbai, Pakistan, or our West Coast of India, or in the PG area. Now, due to this war, not many vessels are ready to come on the West Coast. Generally, on the West Coast, what import we have is like coal. The coal vessels come from Australia, they come from Indonesia, they come from South Africa, or they come from Indonesia, or from China, being steels and all, or other import cargoes, which we are importing from other countries. But right now, the situation is like not many owners are interested to come to the West Coast because of the war, because of the risk they have. Or if some has already been on the voyage before the war, so they have come on the West Coast, but they are denying to go to PG. So if you say on the whole, if we see in the whole, the availability of the vessels is not an issue. But if you see the pinpoint location, nearby trade or nearby the movement of the cargo, the vessels are less, or the owners are reluctant to call that area.
Okay. So coming to you, Rahul, I want to understand from you if we break it down commodity wise, like iron ore, coal, fertilizers, where are you seeing resilience versus pressure in trade flows? Is coal structurally declining or just cyclically weak?
Okay. So when we talk about in this context, the Middle East crisis in this context, the export import from Middle East is certainly disrupted, and we are talking about roughly around 150 million tons annual exports from this entire region. When I say entire region, it includes Middle East and countries like Cyprus where the attacks have been, and almost similar volume they import as well. They export iron ore, grain, they export iron ore, aggregates, and limestone, and a lot of fertilizers, basically. While they import some amount of coal as well, iron ore, grain. So a lot of very very versatile and diversified number of commodities. So they are certainly disrupted, all of them. But when you see in the global context, any slowdown in coal trade is I will say this is structural now. Coal trade is certainly declining. The growth of coal trade is certainly declining. Many countries are switching towards more and more renewable sources. So Europe has cut down. We used to see a few years ago more than 100 million tons of coal going into Europe. That has come down to 50 million tons, almost 50%. Countries such as India, we are still heavily dependent on that. China, despite switching heavily on renewables, still importing in huge volume. There are some emerging economies like Vietnam. They are importing a lot of coal now. So, everything, all these put together, I'll still say that the growth in coal story might not be as deep or as sharp as we have seen 10 years ago. So that has structurally come down now. For other commodities such as iron ore, since 2016 or 17, for last 10 years, I've been hearing that the Chinese iron ore imports have plateaued and they will not, their import will decline from the peak. We have not seen that happening except for the past 2 years. So that the story is still there. And it's good to remember that we are still talking about 1.6, 1.7 million tons of a billion tons of coal, iron ore being traded. So that way, iron ore story is still there. Coal story is still there in terms of volume, but the growth rate in terms of trade is certainly declining. So that is going forward. This is the way that we see the market to be. More and more new commodities coming up. So, for example, when you switch from coal towards more renewable sources, you trade off nickel ore, manganese ore, you trade off bauxite, that increases. You trade for lithium ore, which is spodumene, to manufacture batteries. That has been increasing a lot. And these, for example, this spodumene, they are not traded in very huge quantities. Still, we are seeing at 5, 6, 7 million tons of trade every year, but they're traded on Panamaxes. So they're still big parcel sizes. So there are more and more new commodities coming up, and growth in the more traditional, cargoes such as coal is not that bright compared to these.
Rahul, similar to your answer, we have a question from our audience. They're asking, with India's agri exports heavily reliant on the Middle East, could this concentration lead to structural change in freight rates and vessel deployment over the long time?
Okay, first thing is that the reliance on Middle East is still going to be there. Middle East will import grain. They do not have their own fertile land. Not a lot of them have a lot of fertile land. So they will be dependent on imports. This crisis, as Captain Vijay was mentioning, that this might not go for forever. There will be a time when we will see normalcy in everything, and they will be reliant on Indian rice. They will be importing rice in huge volumes still then, and overall grain. So this is just a short-term disruption. We do not see it as changing anything structurally, and also because of the relations, the political relations with India and many Middle Eastern countries. So we will see this disruption in trade to be fading away with time, and the same trade being again, resumption in trade.
Captain Vijay, what are the safety and compliance risk involved in increased ship-to-ship activity under such volatile conditions?
Uh, that's a good question, Monica. What I can see, there are only two places where we can do this STS right now because do the STS, we need a lot of equipments. It's not a very easy process. These are the two giant ships. Sometimes we do VLCC, which is 333-meter long, two ships bringing together, transferring that 3 lakh tons of oil from one ship to another. A lot of compliance needs to be done. We need to be audited by the oil majors. We need to have a proper equipment, and not many. We are only two companies which is equipped to do that right now in India, which is doing the STS operation. So looking at the volume, yes, we are not really ready to accommodate all those ships. But yes, if it increases, definitely we will buy some of the equipments and we'll be ready. But then again, the space is a big problem. In We have only 2 nautical mile circle, that is a 4 nautical mile circle, 4 nautical mile area we have where we can do this STS, and maximum I feel 3 to 4 STS we can take place at a time. So in case this Saudi Aramco thing works, we need to work with the port and allocate some different positions to accommodate those cargoes. But yes, it is very difficult. It's not very easy. We have to plan a lot. That is at least a 1 day full preparation for fendering the ships, getting the hoses on board. Then there are very significant move I can see in the Kandla port. There are triple STS of bulk carrier I can see, which was a very significant move in Kandla recently. Of course, I'm not doing it, but there are some photographs I saw, and yes, it's a very interesting. So in the future, I think when Indian ports are not ready to handle so many cargoes, this will be the only option what we'll have, where we will be doing the ship to ship. We'll store the cargo in one of the ship, the other ship goes and bring back the cargo. So something like that will definitely take place.
So, are you seeing ship to ship here as an opportunity for the business to flourish, or is it a
Yes,
temporary phenomena?
no, because Indian ports are still not equipped to handle the big ships. If you see the crude oil tankers, big crude oil tankers, there are very few SPMs. And India's demand is increasing day by day. We are bringing up a lot of refinery. Refinery is getting advanced. They need more crude. And their demand has increased as far as crude is concerned. So definitely I can see there is a growth. Then again, the LPG also, they were working on the HPC. I was working very closely with the HPCL, BPCL, and IOC, where they want to make a model where they do the STS operation, store that cargo, and other ship goes and brings the cargo again to the Kandla and all this region, which caters the LPG requirement of the Delhi and all this Jaipur and all these places. So yes, I can see some increase, but definitely, as you said correctly, it will increase the cost. It's an additional layer. But looking at long term, definitely it's a good option. Rather than keeping the vessel waiting and paying the demurrage, STS is a good option. I feel you can save a lot of money in
I
that.
understand. Captain Amit, I want to ask you, last question which I asked you was related to the availability of Supramax and Panamax segments. Continuing that previous question, I want to ask which vessel segment, Capesize, Panamax, or Supramax, do you see outperforming? Which vessel is outperforming and why?
Ma'am, outperformance in the sense on the trade. Uh, First of all, in that this particular region, I'm not seeing uh, Cape vessels are less, but Supramax, Panamaxes, and Handymaxes are equally performing. Performance in the sense, I would say that owners which the vessels are opening in this region uh, are taking it as an opportunity of the risk area to get the more higher per day, I would say. Also, some of the vessels I would discuss on the insurance part. Also, they are adding their own, benefit into that, getting higher insurance for covering up the risk area. So I would say vessels, Supra, Handy, Panamax, equal opportunity, but the owner are quoting higher to the said area to get the benefit of that risk and
Captain Amit,
trade.
recently Iran asked for $2 million per vessel to be transit. So I want to ask, if transit costs like this reported at $2 million per vessel becomes normalized, how will that reshape global trade economics?
Okay, ma'am. So this insurance part has come up. Let's understand on the basic first. The calling PG or the calling PG area is the additional risk which owner takes, and there he goes to the insurance company to take an additional risk of that particular trade of that particular time. So this insurance premium is not for the year but for the trade, and it is basis 7-day basis, and that is called AWRP, additional war risk premium. So talking on an example on a layman basis, a Supramax which is going inside the PG and discharging the cargo or loading the cargo and then coming back outside from Strait of Hormuz, it generally takes 7 days. In 7 days, he will go inside, he will load or discharge, and then he'll come back again. So for that, earlier, before the war, it used to be like 0.2% or 0.25% of his hull value. So let's say if the Supramax is of 15 to 20 million, so $40,000 was the AWRP, which we used to pay to owners. But in the recent times now, the P&I clubs have withdrawn cover. They are the clubs, the insurance companies are not giving the cover at all, or they require special approval. And in some vessels, they are not covering at all. Now, we have asked many, like we are working in this area very frequently, we had asked many. Some have quoted us like 100K they will take for calling, and they are allowed. They can go inside and come out because they have done it in the past. In the war time, basically, they have come out. So they say, no issue, we can go in, but we will charge 200K, 300K. Now see the cost, before 40K, now 200, 300K. So this is and coming on the first part, like the 18 crores or 2 million we will pay to Iran, and then they will allow us to transit the Strait of Hormuz. I was speaking to the P&I, our the cover which we get from our P&I for our vessels. We generally discuss with them. I discussed this particular part to them that is it possible? Now he was saying that the P&I was saying, the insurance company was saying, the traders or the exporters or the cargo shippers, they are ready to pay 2 million on the freight, extra additional on the Strait of Hormuz. But the insurance companies are not confident. Because the movement is basically on demand and supply. So if there is a demand of the cargo and it is a standstill, so the demand will increase, so the receiver will pay a premium, so the shipper will agree to on that premium. So on the trade part, it would not be an issue, but the problem is with the insurance companies. Now what they say is, in the Iran, now Iran has said like 2 million you pay and I'll allow you to cross the Strait of Hormuz. Now whom to pay? Because Iran is not working on a central command. Now when the war happens, there is a central command, and there are different teams below the central command, which obeys the orders. Now in the war, the central command is blown off. The second and third tier is also blown off. So now the Iran is working on the Mosaic doctrine, which they say that there are 27, some they say there are 27, some say there are 31, different units in different parts of the Iran, which are not in touch with each other. They already have the printouts in their drawer, and they have been instructed that if the top 2-3 leadership are gone, you just remove this paper from the drawer and start shooting out the missiles. Now the insurance company says that, okay, we will give the insurance, and the shipper or the the cargo owner will pay 2 million, but whom to pay? If I pay 2 million to one team and the other team which is not aware and my vessel passes and then the torpedo or the missile hits, who would be
So
responsible?
there is no guarantee,
Not
you mean
insurance.
to say there is no guarantee even after paying $2 million or 18 crores in Indian rupee. I want to ask another, follow-up question. Insurance premiums have reportedly surged to the level exceeding vessel values, in some cases about 10 times. How sustainable is this? As
Yeah.
in, this question is to Captain Amit and
Uh,
Captain Vijay both.
Ma'am, this is not sustainable at all if this goes. Sometimes, which means at this level, insurance itself is becoming like the cargo value is not such, and the insurance company has quoted so much. So this is unsustainable. Yeah, there would be some plus and minus. There would be if there is some guarantee from the if there is some clarity or some guarantee from Iran or clarity to the insurance companies that paying some additional premium or pay some additional cost like toll fee if you can on the layman terms to cross the Strait of Hormuz, they are ready to pay, but they are just waiting for some clarity.
So the similar question is
That's
to
it.
Captain Vijay from the perspective of STS, with respect to the insurance premium, how sustainable it is, and are you also facing the similar problems with
I
the
feel,
insurance
Monica,
company?
it will be depending on the cargo. Like India needs that LPG badly, otherwise there will be people will not be cooking the food. So it will be demand and supply. So even if they say okay, whatever the 10 times the ships cost, they need to give because we need those gas in our house. So it will be a demand and supply. And $2 million, it just I think media figure, as Captain Amit said correctly, it is just nobody knows whom to pay that. And insurance company is also scared because then ship is hit, they will ask for the cost of the ship, which is will be difficult for them to pay when you know the risk is there. So for their procedure, they are not allowed to do that. So as I said, we need to watch carefully and we need to wait patiently just to end this and then start because speculation now will be just a speculation. It will not be based on the facts or fears. Thank you, Monica.
Thank you. I want to share the poll results with you all. So we asked 7 questions to our from our audience. The first question was freight rates today are being driven more by disruption and cost than by actual cargo demand. Do you agree or disagree? About 100% of audience have said they agree to this. We had a question number 2. Global dry bulk is still heavily dependent on China, and that remains the biggest risk. In this, 72% of people have said yes, and whereas 28% disagrees. Then we had a question number 3. India is set to become a major driver of global dry bulk demand in the coming years. And about 76% of our audience feels yes, we agree to this. We had a question number 4 for India. Diversifying imports sources is not more important than optimizing for the lower cost. And about 85% of our audience feels they agree to this. We had question number 5. Maintaining higher inventory or strategic reserves is becoming essential for import dependent sectors in India. 81% of our audience feels they agree to this. We had question number 6. Strong supplier partnership and strong long-term relationships will matter more than price negotiation going forward, and 96% of them feel they agree. We had last question on procurement. Team in India are still under-prepared to manage risk like freight, volatility, currency, and geopolitical. About 74% of the audience feels yes, the teams are under-prepared. So coming to you, Rahul, I want to ask you, how do you see the current demand-supply balance in dry bulk evolving, especially with fleet growing outpacing cargo demand in 25-26? Rahul.
Okay, thank you. In 25, yes, we saw that growth in supply was more than growth in demand. And hence we saw rates actually falling down in 2025. So we saw a huge increase in rates in 2022 in that period, but it went down in 25. We do not see that happening in 26. So we expect that the global demand is intact, and despite a number of deliveries which are scheduled this year, the fleet will grow for sure. But at the same time, there are a lot of other factors influencing supply. Supply is not exactly the fleet. Fleet is, supply is derived from fleet. So in that context, when we call supply, it also involves the speed of the ships or the time they are available to trade. So with new regulations coming up, a lot of them have come up in 2026. For example, EU ETS, 100% applicable from this year. And there are a lot of decisions also being taken at IMO in 26 and 27 as well. So in the larger context, coming to this question particularly, we see that the dry bulk supply will not grow as much as dry bulk demand. So we are expecting demand to outgrow supply this year, and we believe that the market might see better charter rates in 2026 compared to 2025 across all segments, more for cape sizes, but across all the other segments as well.
And Rahul, following this from a data standpoint, how much of global bulk and tanker trade is currently impacted due to the disruption in the Persian Gulf region?
Okay, so I will take the bulk part first. So we are talking about roughly 150 million tons or 150 odd million tons of exports from that larger region, the war-affected region, and a similar volume of imports. So almost 300 million tons of export from that region and import from that, putting them together. And similarly, roughly around 50 million tons of intra-regional trade between two countries in the same region. So roughly around 350, 360 million tons of annual trade. Okay, so this comes to around 30 million tons every month. And when you look at their demand, when they export, this region exports, so the destination and where does this region imports from, so the source, when you put them together and you derive this 10-mile demand, so in that context, this is not, a lot, still not minuscule. So almost roughly around 6 to 7% of total shipping demand. When we say shipping demand, it's total 10-mile demand. So that is being affected at the moment, as we speak, till everything becomes normal. So we are talking about roughly a good impact on the overall supply demand scenario in that region, in the bulk, in the dry bulk segment. When you talk about the tanker demand, so tanker is a little bit tricky in the sense that for dry bulk you have alternatives. In tankers you do not have. So almost roughly around 20% of the global trade, global crude oil, that comes from that region particularly. And when that is disrupted, we are actually losing 20%. And you have some spare capacity. So there are other regions, for example, Russia, US itself, there's Brazil, Argentina, Venezuela, which was dark trade earlier, gray trade earlier. Now that has become white almost. So there are other regions also which could supply, but most of them, they do not have spare capacity. That additional spare capacity is still with this region, the Middle East region. And that is being disrupted. So we are effectively seeing out of 40 million barrels of trade per day before this happened, we are seeing a disruption of roughly around 8 to 9 million barrels per day of trade at the moment. Roughly, I mean, you can discount one or two ships which are passed through from that region, but not accounting into that. If this goes for long, we are actually losing 20% of the global supply. So in that context, we have to live with only 80%. You do not have a spare capacity anywhere else at the moment. Building a spare capacity will take a lot of time. So we have to, so in our economics classes, when I was in the college, we used to, always hear that there might be a time when your supply becomes demand. So this is the scenario actually. Your 80% supply will eventually become your demand. So that kind of, but of course, if this goes on and on for a very long time, only then.
Right. Captain Vijay, I want to ask you the last question. Does STC increase cost efficiency or does it add another layer of cost and risk?
It will be again depending how long the ship is waiting. If the ship waiting is more, say, 4, 5 days or 10 days, obviously it is a very cost-effective decision. Like one of the ship, I remember they have touched the Russia and then she came in the sanctions. And she was waiting for 1 month with 1,000 tons of chemicals. So we did STS, we transferred that cargo to other ship and we saved money for it. So it will be again, as I said, it is of course additional cost because war is there and that is what created this kind of situation where they need to do the STS. So yes, I would say it will add the added cost to the final consumer. I feel we are the normal people. I think we'll absorb that cost in the final cost,
Right.
increasing the petrol price and all this stuff. Thank you.
Oh, okay. And Captain Amit, I want to ask you how the contract structure is changing. Are we seeing more spot exposures versus long-term charters?
Yeah, yeah, ma'am. Nice. Ma'am, there is a little bit shift on the long-term contracts because earlier when there were the stability, so there were long-term contracts of 25 years, 5 years, 10 years, 15 years. That 25 years also we have LNG contract with the Qatar from Qatar to India on the LNG side. But now seeing this recently, Qatar, the LNG terminal, they declared force majeure basically. So now there is a speculation that these contracts, if there is a force majeure, then it is very difficult, and then this is a costing involved, and also the it is like the LNG. It is basically the very much required for it is a essential commodity which cannot be ignored. So seeing this, now the charterers are opting for shorter contracts, safer routes. They can pay more, but they need surety that I will get the supply. So shorter contracts, maybe a month, maybe a year, maybe 6 months, and longer routes. They are okay with the longer routes if they are getting the short supply without a risk stability on the routes. So this is the right now I am seeing the changes in the contracts basically.
All right, audience, with this, we come to the end of this webinar. If this situation persists, it is very difficult to say what will happen in the next 3 to 6 months. I want to thank our panelists, starting from Captain Amit, General Manager Chartering, Bainbridge Navigation Private Limited. I want to thank Captain Vijay Hadkar, Head STS Operations Ship to Ship. I want to thank Rahul Sharan, Deputy Manager, Bulk Research, Brewery Shipping Consultancy. And just to inform to our audience, we are pleased to announce our upcoming webinar on global raw material sourcing strategies for India, navigating risk, cost, and supply security. It is scheduled for next week, Tuesday, on 31st March, as global trade dynamics continue to evolve amidst geopolitical uncertainties and supply chain disruption. This session will focus on how Indian industries can strategically manage sourcing risk, optimize cost, and ensure supply security in an increasingly volatile environment. And with this, I want to thank you all for this enthusiastic participation in the poll and in question answer rounds. Thank you, everyone. Have a cup of tea and enjoy your evening. Thank you so much.
Thank you, Monika ji, and thank you,
Thank you so
Metalogic.
much.
Thank you, everyone. It was quite a knowledge enhancing experience. Thanks a lot for inviting me.
Thank you.
Thank
Thanks
you
a
so
lot, all
much.
of you.